Martin Crabb from Shaw and Partners is a tough guy himself, and he's here to walk us through it. Martin, good afternoon to you.
Good to be here, Nadine.
What do you think of the market today?
Interesting, incredibly narrow trading range, that chart you had up before. Usually we see the market open on its lows and rally, or open on its highs and sell off, depending on what's happening in the region. And there was lots of news in the region, right? There's lots of data coming out of China. You know, as you were talking about earlier, the rate move didn't happen from the People's Bank of China that everyone thought. We've had a bit of M&A activity, so we had Rio overnight having a bit of a swing at Turquoise Hill. We obviously had that bid for Unity. So there's lots going on, but the market just didn't want to move all day. It just stayed in the 3, 4, 5 point trading range, which is quite odd.
Let's talk about resources. They're just fascinating place at the moment. There's so much underneath the surface. Lockdowns in China, that is really dominating. And it's still, in a normal circumstance, it would be absolutely dominating the headlines. But of course, with what's going on in Ukraine, it's taking a bit of a backseat. But is that something that us as Australian investors need to be paying a lot closer attention to?
I think so. I just think it's that whole narrative, Scuddy, about supply chains. And you know, you guys are talking about neon gas, which is used to etch chips. So it is required to make chips for semiconductors, as well as the signs outside the kebab place late at night, Scotty, which you're probably more familiar with.
Old days in crow's nest, absolutely.
Yeah, so obviously we know about food and energy coming out of Ukraine and Russia, but there's also the whole China, you shut down Foxconn, you shut down Apple's iPhone business, and that's a multi-billion, trillion-dollar business. So a lot of the tech stocks in China got absolutely smoked in ADR form last night, down 10, 20% in some cases. So that Hong Kong tech index is down 6%, 7% 2 days in a row. So if that's happening, then our tech sector is going to get hit. Also, we had a firm, I'm going off resources here, but a firm didn't get their bond issue away last night, $500 million asset-backed security loan that the Cornerstone pulled out. But back to resources, the volatility's insane. Nickel being $100,000 a tonne and the LME locking up, and that hasn't traded yet, has it?
No, it's coming off March.
Back online tonight, so who knows what's going to happen with that. Are the Chinese going to cover their short? They say they're going to get more short. It's all over the place, right? So I think today was a lithium day, so I think lithium hydroxide prices have gone absolutely nuts. They've gone from $5,000 to $50,000 a tonne, and you can't get the stuff. So Ford came out last week saying we want to make 2 million electric vehicles by 2026. They have not procured any battery raw materials to do that. So where are they going to get that from? So this shortage, this supply chain issue, it's probably the biggest risk to your portfolio. We call it a poison and the cure. So the poison's inflation and the cure is commodity prices and energy. And today was not a day for those, but I think we're still in an environment where having those commodity and energy hedges in your portfolio still make a heck of a lot of sense.
Okay, so cue all of the small cap explorers putting out lithium announcements tomorrow, but where do you look for solid exposure to that commodities thematic now?
Yeah, look, it's probably safer to go with someone who's already got a mine and is already producing. So I think that narrows it down to people like Pilbara Minerals and Allchem, the old Orocobre, because they've already got pretty well advanced projects and pretty well advanced production, rather than waiting for someone who may have a deposit, because even though there's lots of lithium around, it is difficult to get out of the ground. And so, that's probably the safest bet. So what we've done is like a no-brain approach is to buy Independence Group, because it gives you exposure to a number of different battery raw materials. Their bid for Western areas is probably looking like they may have to up that, because the independent experts are saying, hang on, nickel's $100,000 a tonne, maybe this is not fair and reasonable after all. So they're going to go back and think about that and probably wait for the LME to open. But I think Independence Group is the stock we've got in our portfolio to give us that future-facing commodities exposure.
I've got to ask you about bond proxies at the moment. We've got the Federal Reserve going to announce an interest rate decision in the early hours of Thursday morning. Look to be pretty aggressive when it comes to the rate tightening cycle we'll see. Does that concern you, given everything else that's going on in the world?
I think if the Fed futures market's right, we're in for a pretty tough year, because they've got not seven rate hikes baked in now, but more than 7. So we could have 8, so one of 50 at some point this year, because there's only 7 meetings this year, right? So one of them would have to be 50 points for the yield curve to be right. So that's the futures pricing as of last night. You can see that we need to be 1.78 by December 2022, so that's more than 7 hikes. And then you're looking at almost 2.5% in 18 months' time. So that's a very aggressive move in rates. If that happens, into what we know is a slowing economy. The University of Michigan Consumer Sentiment Indicator was out the other day. It's the lowest since the GFC. So Americans are not confident, and we need American shoppers to get the world going. It's like 2/3 of their economy, and their economy is like 20% of the world economy. So if those American shoppers aren't feeling confident, we've got a problem. And the Fed hiking that aggressively would obviously make confidence even worse.
What happens to equities, loosely speaking, in that 2.25% environment?
They go below where they are today.
Yeah.
I would have to say. Look, as we know, the PE is driven by the long end of the yield curve, not the short end. The short end's really about earnings and sentiment, but at the moment they're both going up, so the long end's selling off as well. US 10 years are 217, 220 last night. So big sell-off in the long end and a big sell-off in the short end. So really not conducive for equity. So what we're seeing is tightening financial conditions. We're seeing yield curves rise, and we're seeing corporate debt spreads widen. So it's harder to get money, therefore risk assets do poorly in that environment. And you've got concerns about growth. So it's not a time to be super aggressive, but valuations are starting to look interesting.
Yeah, one thing that struck me about that chart up there, the back end of that curve, it was in backwardation. So you've actually got to starting to go forward, implying that there might be rate cuts, which then implies that maybe there's going to be a policy error in tightening too quickly.
Yeah, so will we see the Fed cut rates in the back end of 2023? That's what the yield curve's saying, which is a bit odd. Also, the 7-year US Treasury is trading above the 10-year, so we've got backwardisation in the yield curve as well. So it's interesting. So the narrative there is that we tighten the heck out of rates, we destroy the economy, we get rid of inflation, and then it's back to the races again. But in the meantime, you can toast a lot of cash, can't you?
Yeah, so where do you want to be invested in that environment? Outside of the resources space, which is doing pretty well at the moment, what are the opportunities? Because it's such a tricky environment.
Yeah, so look, floating rate securities is probably a good place. So we've got tier 1 bank hybrids in Australia, so you can buy tier 1 bank hybrids which have floating rate notes. So as the cash rate goes up, you get a pay rise. Within the equity market, obviously commodities and energy, but then you've got pricing power. So if we have a stagflationary environment, which companies can pass on the high input prices? Now, the Reserve Bank minutes today referred to this in their business liaison. So for viewers that don't know, the Reserve Bank talks about 1,500 business liaison people. They include people in real estate, business, etc. And they do that on a regular basis to try and get a pulse of the economy. And they're hearing back from people that they're more inclined to pass on higher costs to their customers. Now, ProBuilds couldn't do that, which is probably why ProBuild went bust, but some other businesses can. So Transurban's an obvious one. Maybe Qantas in the domestic market, because there's not a lot of competition. Maybe they can pass higher fuel costs on to customers. Amcor in the packaging space, Bramble in the pallet space, Australian Pipeline Trust with their gas utilities, they're all CPI-linked contracts. So there are some businesses that are, strong franchises, will do well in a slow growth environment, and we've got lots of those in the portfolio as well, because that's a good defence against a stagflationary environment.
Okay, so the RBA is one factor that investors have to keep in mind. You mentioned the business liaison program there. I mean, I love hearing about what people are talking about in the real world out there. I was speaking with somebody in markets yesterday saying he was, speaking with a lot of people in family offices and small businesses, just that actually one of his reflections was, this hybrid work thing might not actually be here for the long term.
Right.
What are you kind of conversations are you having right now out there? I mean, are people really nervous at markets?
So depending on who you speak to, so it's like most issues in the market, if you talk to the real estate owners and brokers, it's all returning to normal, it's all going to be great. Everyone's going to rush back to work in the city and work in big offices, and everyone hates work from home, so that's not going to happen anymore. You talk to businesses, like talk to some of the tenants of this building. So you've got KPMG, you've got Westpac. They're not coming back, not the way they were. In fact, there is a fair bit of office space on the market in Sydney from companies that just go, we just don't need these big floor plates anymore. So I think reality is probably somewhere between the two, but I just think that, anecdote of one, Chifley Square, where Shaw and Partners offices are, the food court is packed, you've got to queue up for food. Now, 2 weeks ago, you could fire a cannon through and not hit anyone. So it's all switched on all of a sudden, but that's one building. Different parts of Sydney have different issues as across the country. But also James Gorman from Morgan Stanley said we're not going back to 6-day weeks or 5-day weeks, maybe 2, maybe 3. but the 5-6 day weeks of investment banking, those days are over, quote unquote. He said that at the AFR Business Summit last week. So we are hearing from big corporates that they don't need the space. Smaller companies, it's harder to have flexibility because if you want everyone in, you have to organise for peak occupancy. But I think, I think I'm still nervous on that whole going back to shopping centres to do your shopping, going back to the office to do your work. So certain pockets of real estate, I'm still a little bit nervous about.
It sounds strange, but there hasn't been a lot of travel around the country recently. But you've actually been one of the few that have been able to go and see what's been going on and speak to voices across different parts of the nation. Anything that struck you in your recent road trip you've been up to?
Yeah, I think lockdown fatigue. So the Adelaide Fringe Festival's on at the moment. Now, I'd never been to this before. I've been to the one in Edinburgh. The one in Adelaide is the second largest Fringe Festival in the world. It's fantastic. If you get a chance to go, go. But I was speaking to one of the organisers there, and they said they were budgeting for a significant improvement in interstate visitors. They're just not getting it. So people from Adelaide, up and at it, big attendance, really good turnout and great shows, but the interstate traveller market's still not there. So I still think there's a reluctance just to go nuts again.
Yep.
I mean, I did three states in 3 weeks. My chairman and CEO did 5 states in 5 days. So Shaw and Partners is doing its best to stimulate the aviation sector.
Well, coincidentally, Hello World Travel is just out saying that flight bookings are running at over 50% of FY19 volumes and are continuing to climb. Year to date, as of March 6, we're at $547 million, up 121% on last year's total. So things are slowly getting back.
Yeah, it's really interesting too, and I'm sure that what's going on is airlines are reducing capacity and keeping capacity off the market to go and keep the flights are much more full now, but there's far fewer, and that probably explains why there's a lack of interstate travellers going to the Fringe Festival, because simply it's so expensive. It's so expensive to go there at the moment.
Yeah. Listen, so we are motoring toward the FOMC. That's going to be big this week. Jobs here in Australia. So when you guys are you seeing a lot of corporate activity slowing down, Martin, now?
Yeah, look, I still think corporate activity is up and about. It's probably shifting a little bit from raising capital to doing M&A transactions. So I just think we're at a point in the cycle where the balance sheet repair has been done. That was done in 2020. The confidence to go and do a deal was probably not as much there in 2021, but I think that confidence is starting to come back. So I think the cost of funding is rising. So a huge new round of capital raising is probably not what we're going to see. What we're probably going to see is more M&A activity.